45 years, zero name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Thank you everybody for joining us tonight. I'm so excited for our topic tonight. We're going to be giving you a market update and talk about financing for real estate in 2025. I know there are so many questions and a lot of buzz topics that are, hanging around this specific topic. So Reed's going to do an incredible job for you. But before we dive into that, maybe just give you an overview of me and Marshall Reddick and Reed. So a little about me. I'm a licensed realtor here in California, Orange County specifically. And that beautiful gal on the right there is my sweet wife. We're about to celebrate our 2-year wedding anniversary. And that is our 3-month-old baby girl. Her name is baby Cammie. So little Cammie Lee there. She's the joy of my life. Reed and I were just talking about how I'm about to go travel to Kauai. Very nervous for plane flights. So put in the chat if you guys have traveled with a newborn or a young kid before. Give me your tips there. Definitely use some tips. But I own my primary here. I invest in real estate. I've done transactions in several states. I help a lot of landlords find property management here at Marshall Reddick. And obviously, I do sales in state and out of state. And a part of my role there is being the real estate advisor. So for some of you, you might be familiar with who Marshall Reddick is. And for others, maybe this is your very, very first time hearing about us. Welcome, very excited to have you. But essentially, we are a full service real estate firm, and we have 4 divisions within the company. The first division is obviously the real estate brokerage. So we help people buy and sell their primary homes, as well as buy and sell investment properties. And we nationwide, I'd say we did about 500 to 600 transactions last year. And 90% of those transactions that are investment transactions, we also manage. And that brings us to our second division, which is property management. We basically take care of everything for the landlord, from leasing to maintenance to renovations to rent collection and so much more. So basically, you as a landlord, all you need to do is collect a rent check every month. The third division is private lending. So sometimes if you can't qualify for a conventional loan, you might need to get private financing. Marshall Reddick provides non-owner occupied real estate loans to borrowers doing like fix and flips, new construction, and purchasing investment property when you can't go conventional. And then the fourth division is mortgage investing. So the same way that we were just talking about how you can own real estate and collect a rent check, our investors can own mortgages and collect mortgage payments. Now, I personally invest in the Marshall Reddick Mortgage Fund, and so does Reed. It's a good option where we don't really have to think about it too much, and we just collect the quarterly distribution being a part of a fund. And as I mentioned, within all of these, I am a real estate advisor here. So think of me as like your real estate quarterback. So whatever direction you want to go, whatever state you want to go, I'll be the quarterback of the transaction or wherever you want to do. And then I'll loop in my key players, my running backs, my wide receivers as we need in order to get you to the finish line. So Marshall Reddick's located in 10 metropolitans across the United States, and you can see them here on the map. In California, we have Los Angeles and Orange County. And then in Texas, we have Austin, New Braunfels, San Antonio, Houston, and Dallas. Dallas is one of our newer markets that we're growing in. In Tennessee, we have Nashville and Clarksville. And then in Florida, we have Cape Coral. And you may be wondering, why these states? What made you guys choose these markets? And as an investor, it's very important which market you choose. And there's several reasons why we selected the ones that we're in. Well, first, we're looking for, markets that have good economic growth, low unemployment rates, a stable jobs market. We also want a market where there's high rental demand, right? These are markets that are very landlord friendly. They have a good ratio of renters to homeowners. These markets are very diverse in economic industries. We like to see a variety of essential industries like military, medical, insurance, communication, IT. If there's just one of those and that market crashes, the whole market's done. But when you have a good variety, it's a more stable market altogether. Also, it's important that the market has a low barrier of entry. Are the houses affordable for investors? Maybe the suburbs have more affordable, family-friendly neighborhoods. And we'll explore a couple property picks later that Reed and I are going to review with you. But we also want a good education system that leads to well-educated tenants and more desirable school districts. Maybe there's good high schools, maybe there's a university in the area. Those are all things to look out for. And one of the most important criteria is good property management. There should be a good selection of property management companies that are competitive with one another to produce good service. The last thing you want is to be stuck in a situation where you have a bad property manager and there's only one or two other companies and they won't provide much better service. That's why for us, we do the property management to make the purchase and transaction easy with a very smooth handoff. And so for those markets, I have a quick photo here from some of our teams. Top left is going to be our New Braunfels, Austin team. Top right is going to be San Antonio and Houston and Dallas. They all flew in. And bottom right is going to be our Tennessee team. Bottom left is going to be Florida. And then we've got our California team here in the bottom middle. Some of our operations are in there. And within all of this, I am so excited to introduce you to Reed Hazard. Not only is Reed an incredible lender, an incredible resource, he's a good friend of mine. So Reed and I, we get a chance to hang out, and you know, it's nice to learn from him, being just a slight ahead of me, having kiddos. And Reed does my loans, my family's loans, basically loans for anybody I know too, and he's just a wealth of knowledge. So without further ado, Reed, handing it over to you.
Thank you, Cameron. Great to be here with you guys. That was a great introduction, and I think that you nailed, really nailed it with how we're selecting these markets. Lots of economic diversity, right? Areas where there's tons of different types of jobs. So, you know, if, for instance, if the coal industry goes under, you know, the entire town doesn't move out, right? There's other types of jobs that can come over and take over. So all these markets are very carefully selected. I thought you really covered that well. A little bit about me. I've been doing this now for just about 20 years. I can't wait to say that I have been here for 20 years. I'm almost there. Started when I was 19 with Marshall Reddick. Yeah, and just looking, I'm at 19 years, almost at 20. So super excited to be here and to be a partner of the company. I own real estate in San Antonio, Texas, Austin, Texas, and then here in Orange County. And I've worked with well over 1,000 clients now within Marshall Reddick over the years, and just very, very grateful to be a part of the company and to watch it grow. So a little bit about why CMG. CMG is my company that I work for. I don't own the company. Wish I did, but I'm one of their top producers nationwide. And we're actually the 9th largest bank in the nation, and we did more mortgages last year than Wells Fargo, Bank of America, or Chase Bank, to give you guys an idea. So we're a very large bank. We're not a broker or even like a direct lender. We're the actual bank that's lending out the money and then servicing your loan after the loan closes. So you make payments to my company. We're licensed in all 50 states, specialize in investment property financing. And then, you know, a couple of the other things that we offer that I think are really special. We have the ability to do forward commitment financing. And what that means is that, you know, we're able to attach special interest rates to new construction properties. So you'll see interest rates at 3.75 to, let's say, 5.25%, Marshall Reddick website. And we're the ones that are funding those deals. And I'm going to cover a little bit about how that works tonight. But again, the special financing, you can do that if you have your own securities, which we have CMG securities. We're actually packaging these loans together into bond pools and selling them on the second market to institutional investors. So that gives us just a lot of control that a lot of companies don't have. We don't do anything else but mortgages, so we're the best at mortgages, and we leave the real estate sales up to Cameron and Marshall Reddick. And then another thing that we offer that I love is the refi incentive plan. It's called Rebound, and we will cover the lender fees, most of the title and escrow fees, and the cost of the appraisal for doing a refinance anytime within 5 years after closing. So anyone that's worried about interest rates right now but believes that they are going to come down with inflation over time, you know, again, you date the interest rate, marry the property. if you're buying a primary residence locally, or, you know, again, if you're just, if you don't want to pay a bunch of costs to buy down an interest rate and you would rather do a loan now, take an interest rate at today's market and look to refinance in the future, this is our program that we offer to all of our clients, and it's good within 5 years after closing. I'm going to be covering how to get pre-approved tonight. I'm going to go over the best loan programs available, and I'm going to give you guys a market update, right? What's going on with the market? When can we expect rates to come down, if ever? I think that they're going to come down at some point, but I'm going to be covering a little bit about what's going on currently in our markets and what's affecting rates, and when we might hope that they'll be coming down. So getting pre-approved, always, we used to do applications over the phone with people. But with technology nowadays, it's so easy to do an application online. You can get one done on your phone in 10 minutes, right? So you guys will go to reedhazard.com, click on the Apply Now tab. The real estate advisor like Cameron will generally send an introduction email to us. We'll send a consultation call. And then at that point, we'll send the next steps email. And we'll have you go to my website, do the application. If you're a W-2 employee, we tend to just get 30 days most recent pay stubs, the last 2 years of W-2s. If tax returns are needed, then we will request those. If we're able to qualify you without the tax returns, meaning only off your W-2 income, then we'll just do that. So we always try to simplify as much as we can. If you're self-employed, you're going to have to get the 2 most recent years tax returns. If you're on an extension from the prior year, that's totally fine. But you will have to get a profit and loss sheet for the entire prior year and the current year to date if you're going to do a conventional mortgage and if you're self-employed. Assets, we always ask for the 2 most recent bank statements. There's a really cool thing that changed recently on conventional loans. You used to have whatever borrowers were on the loan, that's where the assets need to come from to buy with. Meaning, if you're going to get a 25% down payment from family, well, that's considered gift funds. You can't use gift funds to buy an investment property, only a primary residence. What changed recently is if, let's say, you're getting a gift from your mother and father to buy an investment property, if you guys all go on the title together as owners, we can do the loan with just you on the loan without your parents on the loan. They all just have to go on the title together. And now it's not considered a gift. Everyone else out there believes that everyone has to be on the loan together or it's considered gift funds. And this is actually not written in the Fannie Mae guidelines, but you are actually able to do that. So on the asset side, we have a couple really cool things at my company that we've been able to do because of our size, and that's one of them. And believe it or not, we come across that like every single week within Marshall Reddick, someone's wanting to do that. So I wanted to point that out. Generally, though, we ask for the 2 most recent bank statements to see where the money's coming from. If there's any large deposits in those bank statements, we have to source where those funds came from. If they came from, let's say, your Charles Schwab account, you sold some stock and moved it into your checking account, we can always source that. But again, 2 most recent bank statements, and if there are any large deposits, just know we have to know where that money came from. And that's why we ask for the assets. And then a copy of the mortgage statement and insurance declarations page for any properties that you currently own. And this would allow us to run a full loan pre-approval. Now we take this one step further. If you're shopping, let's say for a primary residence in an area that's very, very high demand. It could be an investment property too that you're shopping for, but let's say that you're shopping in Pleasanton, California, or you're shopping even here in Orange County, and let's say a $1.5 million range and below. That's a very, very competitive market. So we also do a fully underwritten approval. And if you do a fully underwritten approval up front, we basically take all this information, we submit it formally to my underwriting department. We then get what's called a full credit approval. After we do that, you can actually write an offer to close in 14 to 15 days if you like. And we do that all the time. Cameron and I have a client right now that just went into escrow, and we did a fully underwritten approval. And we ended up getting a little bit more time than 15 days. I think we had like 18 or 20 days. But the point is we can go into that transaction with a lot more confidence. And also on the purchase contract for here in California, there's a section on if the loan has been pre-qualified, pre-approved, or underwritten approved. And if it's been underwritten approved like I'm talking about, you can click underwritten approved. That's going to strengthen your offer. You see, there's a lot of all cash out in the market. people are still sitting on records amounts of cash. And so if you want to look as good as possible to an all cash offer, that underwritten approval is going to get you as close as possible. So that's what we do here with our pre-approvals, just depending on the time frames and what we have to meet. It'll either be a pre-approval or a fully underwritten approval. And getting pre-approved, I already covered some of the reasons why it's important, but really, knowing what your max qualifying power is. Let's say that you're going to do a 1031 exchange and you're going to sell a property you've had for 15 years, starting to get a little bit older, you have a lot of built-in equity. You're going to sell one market and then exchange that equity into 3 other properties in different markets, right? Before you go and do that, let's get you approved to make sure there's not going to be any hiccups, okay? So doing your mortgage planning, there's so many reasons why you want to get approved up front, but that's one that we run into a lot at Marshall Reddick, that again, getting approved up front is going to give us the game plan so that your real estate advisor like Cameron can help you build your game plan on what properties, how many properties, what those prices are going to be. And then we can do the financial math, right? And find out what are the payments going to look like based on the down payments that you're going to be putting on these properties or property. So very important to get pre-approved as really the first step. And there's no cost or obligation to get pre-approved. And also, we're doing most of our pre-approvals nowadays with a soft credit check, not with a hard credit check. In some cases, we have to do a hard pull because there's little pieces of information that we can't get through a soft pull, but it's getting a lot more efficient, and we're finding that you can even run pre-approvals now off a soft pull, whereas before you literally could not do that. Now you can. So again, getting approved is free. A lot of times we can do it with a soft pull, and it's good for about 120 days from the date that we get you guys approved. Okay, now how are we qualifying you? What are all banks that verify your income, meaning it's a full documentation loan, what are they basing the approval off of? It's off your debt to income ratio, your ability to repay. Let's say that you make $10,000 a month in income, and the monthly payment for the home that you're buying as a primary residence, let's say that that's $4,000. 4,000 divided into 10,000 is 40%. You'd have a 40% debt to income ratio. For these types of loans, in general, you can't go above 50% debt to income ratio. And the types of debts that are involved in your debt to income ratio, anything that's on your credit report, debts that are not included, auto or health insurance, cell phone and utilities, if you lent someone money and it's not like a recorded lien out there, things like that are not going to be included in your debt to income. But we all have a debt to income ratio on this call, and you guys could literally pull up your own credit cards and go, my minimum payment on this credit card is $100 a month. Our primary home where we live is $4,000 a month. We have no other debt. We make $10,000 a month. Oh, we have a 41% debt to income ratio. So that's why lenders are asking for your guys' income, is to find out this math right here. And then a little bit about my sales team, who you guys will be working with, names that you'll see, people that will contact you throughout the process. Brian Kane works mainly with me on the front end, along with Mike Lynch, and they work with me on the pre-approval side. Once your file goes live in the process, you'll see Jessica Yinger. She's my loan assistant. And then you'll see Leah Warnick. She's my back-end processor. You'll see her name here and there as well. And then my Raul Rodriguez, he's fluent in Spanish. He does handle some of our files throughout Marshall Reddick. And then David Self. David Self works with a lot of our first-time buyers through our tenant home buyer program. David's a great guy. And again, he's also licensed in about 35 different states. I'm licensed in about 20 different states. My company's in all 50 states. So David also handles certain markets and different referrals throughout Marshall Reddick for us as well. Okay, we're going to cover conventional programs first. It's the most commonly used full documentation loan out there. And you can actually do this loan amount now in Orange County or Los Angeles County or any other high cost market. The highest cost markets in the nation tend to allow you to go to the max conforming loan limit. And that max conforming loan limit, the highest out there, is $1,209,750. What does this mean? It just means that you can literally buy with 5% down and get $1,209,000 loan for a 1-unit property. Now that limit has been increasing every year. It tends to go up with wage inflation. And I'm going to discuss how that kind of affects appreciation too in just a moment. But again, it's just amazing that it's now at $1,209,000. I remember when it was just touching $1 million and we were all blown away. Now it's almost 1.25. So, and then for every other market in the nation, standard markets, 800 and 6,500. You can go zero down on this type of loan program too. You can't do it on a high balance conforming limit. So anything above 806,500, you wouldn't be able to go zero down. It would default to 5% down. But you can do a zero down loan to 806,500. And generally, you know, the best terms are more with 3 or 5% down as kind of a starting point. But again, you can go zero down. And the most commonly used types of loans for conventional are 30-year fixed, and usually like a 10-year fixed, 30-year amortized, or a 7-year fixed, 30-year amortized loans. Those are called adjustable rate mortgages, where they're only fixed for a certain portion of your term. And then basically conventional loans have the lowest interest rates for higher credit tier borrowers. You see, credit scores go from a qualifying standpoint. For conventional loans, about a 620 to 639 is the lowest tier, 640 to 659, and it goes in 20-point increments all the way to 800. Okay, so if you're in that 700 plus in those ranges, and you're putting minimum down payment for, let's say, a primary residence, conventional is always going to have the best pricing. If your FICOs are below that, you start to see that an FHA loan might have better loan pricing, okay? So from a primary residence standpoint, that pretty much explains conventional a lot. And then from an investment standpoint, you can go as low as a 640 mid-score, and it goes in 20-point increments all the way to 800 plus. And you really want to try to be at like 720 plus, and the pricing gets much better at like 760 plus and 780 plus. Okay, and then this is good for up to 10 finance properties. Now, if you can't qualify conventionally, we do a lot of DSCR loans. It's called a debt service coverage ratio loan. We're not looking at your personal income on that type of loan. We're looking at how much is the property going to rent for. If the property is going to rent for $2,000 a month, you need to put enough money down to get your monthly mortgage payment at $2,000 a month. That's a 1-to-1 ratio. And you can go to a 0.75 ratio where you have negative cash flow. The pricing's a lot worse. And the pricing's better if the rents are 20% above where your monthly payment is. That's what's called a 1.2 ratio. But again, if you have decent credit or good credit and you have money to put as a down payment, we have DSCR financing down to a floor rate of about 6.375%. When interest rates tend to get better because they tend to ebb and flow, that floor rate will adjust down, and it goes down to about 6% sometimes. We actually just closed someone that had contracted a couple months ago when rates were a bit lower, and they were able to get a 6% on a DSCR loan. So that's another type of financing that we do when you have good credit or you have credit scores and down payment where we're not using your income. But outside of that, financing for conventional will get you up to 10 finance properties. Another really cool program that's a conventional program where let's say that you're buying a property and you want to have a lower introductory payment for the first couple years. You believe rates are going to come down over time a bit, and you're going to look to refinance this loan maybe in a couple years, but you don't want to take a 6.75. You can do a 3-2-1 buy down. If you do a 3-2-1 buy down, your interest rate is going to start for the first year. You're going to be cutting a payment based on a 3.75%. It's 3% lower than your note rate of 6.75. The second year would adjust to 4.75. The third year would adjust to 5.75. The fourth year through the rest of the 30-year fixed term, it would be 6.75. And if you look down here in the green, you'll see the buy down deposit that's required for this on a $350,000 loan is about $15,800. That's about 4.4% of the loan amount. Well, we're in a market where I would say it's not a seller's market. In my opinion, it's a buyer's market. I mean, obviously in some markets in the US, it might still be a seller's market. That's a cool part about the real estate market. There's like 300 different individual major metropolitans all over the nation, and everyone acts a little bit different. But I would say by and large, we are in a bit of a seller's market right now. So when you have your realtor request a seller credit, right, you can get a seller credit in this example for $16,000, and you could use that credit to get yourself a really low buy down schedule so that you have a really low payment the first couple years as you're easing into your monthly payment. And the coolest part to me about this program, that buy down deposit is being held in an escrow account with the lender. And if you were to refinance this loan through my rate rebound program, and let's say year 3, because maybe mortgage rates are at 5.25 at that point, any money left over in that buy down deposit account that's being used to subsidize your monthly payment, you would be refunded that money. It's not a permanent buy down, it's a temporary buy down. So we can discuss this more later if you guys have questions. But this is a very, very cool product that we've been using now, especially for the last couple of years as we've been in a higher rate environment, to have a really low introductory payment. Now we're going to segue now more into investment properties. The minimum down payment for investment property is 15%. Okay, the minimum FICO score at that 15% down is 660. Then it will go to 640 minimum FICO score with 20% down. And you guys, we all have 3 FICO scores, right? TransUnion, Experian, and Equifax. In mortgage lending, we go off of the middle score between the 3, the mean score. That mean score would have to be, in that 20% down example, it'd have to be a 640 and above. And then 25% down is the minimum down payment for a 2 to 4 unit property. You will not get investment property duplex financing with less than 25% down. It's just a conventional guideline. And now once you have 7 properties through your 10th finance property, as you're building that portfolio, 15% down is no longer available. We don't really advise that anyways. You'd have negative cash flow on pretty much anything out there. We really tend to advise 25 to 30% down. It's a very good leverage ratio. But again, for 7 to 10 finance, you could still go 20% down if you like. And then again, 25% will be your minimum all the way to 10 finance. You have to have a middle FICO score of 720 once you're buying 7 to 10 finance properties. Okay, we're going to cover forward commitment financing. Basically what this means is that the builder is committing to giving us a certain amount of loan volume within a certain amount of time. So they may be committing to, Reed, we're going to give you $5 million of loans from this community that we're selling, and we're going to get it to you within 6 months. Then can lock in a rate sheet with my company. That's a company-to-company transaction. They then can go, we're going to pay for the 3.75 interest rate. And now when you apply with me, we can slot your $400,000 loan, for example, or $300,000 loan into that $5 million bundle of money, okay, at the 3.75 rate. There's a couple points that you will pay depending on your FICO score and the reason that you're buying. And you could always try to negotiate a seller credit for that as well. But again, this allows us to get buy down interest rates attached to new construction property that don't exist anymore, frankly. And also where there's a lot of cost involved in that, the builders are digging into their pockets, into their margin. They're not increasing the sales price of the home. They haven't been able to increase sales price in a lot of these markets for the last 3 years. But again, they want to sell properties faster, and they want to sell properties to investors to get good long-term clients as well that will continue to come back and buy and buy and buy. And they're not going to get that selling an 8% or 7.5% mortgage rate, which is where investment rates are today. But at a 3.75 or a 4.25 or a 4.75 or a 5.25, these are the rates that make the numbers work. And so this is a very amazing type of financing that we have. And we have quite a few different developments throughout Marshall Reddick that these are attached to. And they're generally going to be on adjustable rate loans, meaning that the rate is generally only fixed for 10 years and it's amortized over 30. So it's a 30-year loan, but the rate is fixed for 10. But that initial 10 years of better cash flow, okay, in some markets, I mean, the rents have gone down a lot. They're pretty much at bottom. I mean, I can't imagine that they will go down anymore. Maybe they go down 5% more, but at the same point, we're at or near the bottom of that where they will start to go up again. And over time, because you're securing this type of financing, you're going to have better cash flow within that fixed rate period. And, you know, investors tend to refinance every 10 years anyways, you know, because you get more built-in equity. You get in times within a 10-year period where there is high appreciation again. And because you have that built-in equity, you may decide to do a cash out refinance to leverage into more properties. I've done it multiple times personally. And because we're in a high rate environment right now, if you're taking out an ARM in a higher rate environment, when the Fed is in an easing path, they are cutting rates over time. Even if they're not low yet, over time in 10 years, very good chance that rates will be lower at that point, and you'll be able to, if you like, do a cash out refi into another lower rate loan and pull out some equity to leverage into more properties. We also have 30-year fixed terms for these. The rates are not even much higher. A few of our builders are doing a 4.5% with 30% down, or they're doing a 4.75% 30-year fix with 30% down. So 25% down for, or sorry, 30% down for 4.5, 25% down for a 4.75. So if you must have a 30-year fixed loan, amazing terms. You're just not going to get the 3.75. Okay, and then these are available in Texas, Tennessee, and Florida. And for this type of financing, there's no DSCR or anything like that. This is only on conventional loans. Here's an example of one. I actually bought one of these in December of last year. I have 7 investment properties, and 4 of those are in Texas. And I have 1 in Austin, and this is in Buda in South Austin. I just love these properties. I think that they're very nice looking. The builder spent a lot of money on these, I think going a little bit overboard even in some regards. And they're just beautiful. And so they also pencil out pretty nicely. And when they drop the rate on these down to 3.75 and 4.25 with 25% down, I did the 25% down 4.25. I just thought it was just a great value, and I decided to pick one up as well. I really believe in that Austin market. I mean, that market, yeah, it went up a lot during COVID. It's definitely come back down to reality. But you guys, I mean, there's so much growth in Austin, so much growth in Texas in general right now, so much capital being invested from the hyperscalers and the largest companies in the world. And I just think that you're going to see the market really come back there over time. So I decided to buy one of these myself. This is an example of one where with 30% down, you can get a 3.75% interest rate. The rents on these have definitely, I feel like, bottomed. The rents were a little bit over $4,000 when they started selling the development. The rents have definitely come down. And even in January of this year, though, I was actually getting $1,825 per side. So this is a little bit conservative too on the rents. I think you could probably get a little bit higher than that, but we wanted to be as conservative as possible. And based on an appreciation rate of about 4.5% in Austin, which is a pretty conservative, if you look at a 25-year trend, you'll get a 20% return on investment on this over time. Cameron, if you want to cover, a couple of these as well, I'd love to hear your thoughts.
Yeah, and just to describe what these properties are. So if you guys go to marshallreddick.com and then click the drop down under invest and click properties, all of these properties, including thousands of others, will be there. And so these are all handpicked investments that we've uploaded to the website, and then we underwrote them ourselves. So we got all the figures for what your taxes, insurance, HOA, we know the rents because we manage hundreds and hundreds and thousands of properties in the areas, so we know what they're going to rent for, and we know the sales values, and we put those in so you guys as investors, you can now go on our website and you can run the numbers yourself. If you say, hey, what if I submitted an offer that was like 10 grand less, what would that look like? Or what if I estimated a little bit less maintenance and vacancy because this is a brand new one that's pre-leased? Just an example. You guys can go run those numbers yourself, and it's a really, really cool resource there. But this is the pro forma. So this takes a snapshot of everything that you'll find on those calculators and puts it here in a pro forma, and you can print these out as a print to PDF on any property page. This one here is similar to what Reed was saying, duplexes, newer construction, getting a rate buy down. It's a slightly different community and a different price point. This one is going to be like a suburb of San Antonio. So it's like near New Braunfels, a little lower price points there for the rent, so a lower barrier of entry, but you're going to see similar return in regards to that monthly income. You might not have the same appreciation as that Austin market, like Reed was saying, but you're definitely going to hit a little more cash flow for a lower dollar amount up front. And this is also with 25% down. That's something I want to note. Anything else you want to add on this one, Reed?
No, that was great. I was going to note that as well. This is an example of one that you could buy with 25% down and get pretty decent cash flow, right? And they're doing a 4.75% rate buy down on this one. Oh, that was great.
Absolutely.
I love these too. I mean, if I was in the market to buy another property right now, I never break my golden rule. I tend to buy one property every couple of years, and that's just where I sit. I've bought 2 at once before in 2019 because it was a good opportunity, but I just don't really break that rule. But I think if I was going to buy another one right now, I really like this market. I think that Clarksville is great. These are priced well. And the builder will do a rate buy down right now to get down to a 4.75. Another point is because we're locking in this money in tranches, right? We're locking it in based on where the market is. if the market worsens and then we go to lock in more money, the builder can only pay what they can pay. So now that $10,000 a deal or $15,000 a deal or whatever that dollar amount is, it might not get us to a 4.75, it might be a 5.25. We locked in a pretty large amount of money back on the last time that I felt like it was the best time to lock, and it did end up being the best time to lock. And so we still have quite a bit of that money left over, and so we're able to market this property right now at 4.75. In the future, you might see it back at 5.25. And so I wanted to point that out just in case you guys are ever watching these properties and you wonder why the rates change over time. This property will cash flow with 5.25. But it'd only be about $50 a month. Right now at 4.75, you're getting about $133 a month in positive cash flow. Yeah. A few questions that I frequently get asked is towards my debt to income ratio. Reed, I've already got a 48% debt to income ratio, and I want to go and buy 2 investment properties. I have $300,000 of capital to invest. Okay, well, if we put 30% down, that monthly payment at 30% down, if the rents are $2,000 a month, $1,500 of that, 75% of that $2,000, we can add that onto your income towards qualifying. And so these properties tend to pay for themselves with about 25 to 30% down. So we have clients that already are getting closer to their max debt to income ratio all the time. And because we can use projected rental income to offset that income ratio, that will allow you to continue buying property. After you own property and you put your properties on a Schedule E, which is a schedule of your tax return, and you have your rents and your maintenance and your taxes and all your different expenses and your depreciation, then you have your bottom line income. We can write back in depreciation into the income. But even over time, as you keep these properties rented, because we're buying in markets that are good rental markets that have good long-term tenants, and we're not sitting with vacancies on the market for 4, 5, 6, 7, 8 months like some markets in the US, you tend to have a lot of rental income at the end of each year. And over time, these properties are paying for themselves for your ability to continue buying more property. So that's another really, really important point about why you want to buy in markets with very strong jobs and not so much tertiary markets that are more vacation areas, because you want a consistent rental market so these properties can keep paying for themselves so you can keep qualifying to buy more rental property. So that's a way that we can qualify. If the property is not already pre-leased, every appraisal that you get through a conventional lender that for an investment property is going to have a rental comparable analysis included. It'll show 4 or 5 properties, the one that you're buying, what they're renting for, and then we can take 75% of that amount and add it onto your income towards qualifying. We're going to talk a little bit about how Fannie Mae has increased their loan limits. They increased them by 5.2% for 2025. I mean, for anybody that thought that they were not going to do that last year, wage inflation was still close to 4% last year. So inflation in general, okay, was close to 3% for a lot of last year. So you might not have felt like you had a lot of additional wages to spend money with because the cost of goods going up was still so high. But really, wage inflation averaged 3.8% last year, and it's averaging about the same right now. And only in this environment, inflation still feels difficult, but not quite as difficult because now inflation's down around 2.3% for the cost of goods. And your wages on average are probably going up 3 to 3.5%. So we're starting to see that gap start to widen a bit, which is nice. And the loan limits tend to rise with wage inflation. And home price appreciation also tends to bode into the Fannie Mae conforming loan limits. Because think about it, if you're in a market where the loan limit is $766,500 and you only have 5% or 3% for a down payment, well, there's going to be more demand around home prices that are at or just a little bit above the standard or max conforming loan limit, right? So as they raise that loan limit more, that demand continues to stay strong up to that max conforming loan limit. And we can see it in the data that it has a lot to do with home price appreciation, along with wage inflation. It doesn't work if the jobs market falls apart and no one has jobs, or there's wages are going negative, for example, right? And we're not in that type of a market. But again, that's why the jobs market really is the glue that holds everything together. Here's just a quick little outline on the max conforming loan limits. On the right-hand side is the max conforming loan limit. That's, again, for a 1-unit property, 2-unit 1.548, 3-unit 1.872, and believe it or not, you can get a 4-unit property on a $2.326 million loan amount. You could buy an investment property. I have a guy looking in Culver City right now who wants to take advantage of the market up there. He's looking at about 3.5 million. He's going to be buying a 4-unit investment. He's going to use this type of financing, and he's only going to finance about 2 million, but he can get a conventional loan, which is great. So again, these have a lot to do also with home price appreciation. A little history on Fannie Mae loan limits. I always like to show this because I lived through this time of 2006. I was doing loans, rather. Obviously, I was doing loans for 2006, 2016, 2025, right? And in 2009, right, we had the Great Recession. Unemployment went all the way to 10% in 2010. And then as we saw unemployment and the employment market start to recover through 2012, 2013, 2014, it wasn't until the very beginning of 2016 we finally had some wage inflation again. All right. There was so many available jobs, not enough people to work them, right? And then that's why you get wage inflation, right? Because if there's all these people trying to get you to come on board, they're going to have to pay more to get you on board. Well, when there's a lot of people that need jobs and there's only a small amount of jobs available, you have to work for less to get that job. Well, we started to see a tightening in the labor market around 2015. And that started to finally show in wage inflation in 2016, where you were getting pay increases. And as we saw that for the first time in a decade, the Fannie Mae conforming loan limit went up to $424,100 in 2017. And it just kept on going up because the jobs market was improving. And even through a really high rate environment we've had since 2022, the loan limits have still been going up about 5% a year. A couple more programs I want to note for primary residence financing, VA financing. If you serve in the military, you really deserve to have the best loan out there. And that's what you'll get with the VA loan. 0 down loan with no mortgage insurance. It's only good for primary residences, but you could buy a duplex, for example, or a 4-unit with 0 down. We do a lot of this financing in Texas, a lot in San Antonio, where you can buy 0 down payment. And again, you can get pretty great interest rates compared to standard conforming rates as well. For example, the average primary home rate today for conventional is about 6.875. For a VA loan, you're about a 6.25. So the VA rates are also a little bit lower. And they also give you a little bit more flexibility on your debt to income ratios. You usually can get an approval up to about 63% debt to income. And if you're W-2 or self-employed, no longer in the military, but you still have VA eligibility, of course, you can always go back and use your VA loan. FHA loans. So this is a great product if your credit scores aren't as good, or if you had an issue in the past, maybe a short sale or a foreclosure from 5 years ago. You want to get back into the market. Your credit is definitely recovered a bit. You have money for a down payment. You can get an FHA loan. You can buy with 3.5% down. Okay, you can even buy a 2-unit property with 3.5% down as you like. We have a lot of buyers that are doing that. But again, this is a really great product if your FICO scores are not as high. And you can go to a 57% debt to income ratio for this product. And then the last program for primary residence is a jumbo loan. So any loan that's above the max conforming loan limit of in Orange County, $1,209,750 would be a jumbo loan, and that generally requires 20% down. Here's a picture of me at 19. It's doing the same thing at American Direct Mortgage. It started with Marshall Reddick, like I said. So American Direct was one of the lenders at the time. And I started working with them and going around to all the club meetings at the time and talking about loan programs, and really have a passion for what I do. And I always love seeing that picture. Okay, we're going to give a quick market update. Cameron, do you have any comments or anything before I jump into this?
No, we got 13 minutes, so I don't want to stall you. This is the meat and potatoes here. I'm ready for you to jump in.
Okay, perfect. I'm going to make sure I make it in 13 minutes. So anybody that's on the call, 6 o'clock, we have a hard stop. Okay, so what are rates today? Currently, and have they peaked? Yes, they've peaked. They peaked in November of 2023. That's when consumer price inflation peaked. Okay, so we do know that. Obviously, if we had some type of hyperinflation, or if these tariffs, if it wasn't transitory inflation that we got off the tariffs, and if we really did have 145% tariff on China and they had 140% on us, I pretty much guarantee you that we would go into some type of crazy scenario here where we might have really high rates again, much higher than they are now. Thank God they are striking a deal right now on that. And it's kind of being looked at as these tariffs were more of a negotiating tool. We called that months back. But again, so I can say pretty comfortably, I believe that they have peaked. And as of today is 5/13 today. This is based on May 8th. They were 6.76. They've trended back up again a bit. If you guys Google it today, the Freddie Mac website will not show you past May 8th. They're probably back to about almost 7% again right now. They'll probably edge back down here soon as well. We got some good inflation data today. But as of right now, you're getting a lot of money moving back into the stock market from the bond market, causing bonds to sell off a bit, which drives up the yield and makes rates worse. And a lot of that is because a lot of that money has been hiding out in the bond market away from the stock market because we didn't know if this China trade war was going to go really, really far. It appears it's not going to go as far now. So again, you're getting a little bit of rebalancing going on. I think you'll probably, though, get rates cooling back down again over the next few weeks because we had good inflation data today. And the Fed cares more about inflation and the labor market than they do about anything else. Why do we care about rates? They affect cash flow if you're an investor. They affect cash flow if you're a primary home buyer. Every 1% rise in your mortgage rate is a 12% increase in your monthly payment. That's why they matter. Okay, so when will the Federal Reserve lower interest rates again? Currently, they have 2 rate cuts on their dot plot for this year. The dot plot comes out every quarter, and it shows it's their economic projections on how many rate cuts they see for the current year and for the next couple years. And currently, they have 2 rate cuts still on their dot plot for this year, probably going to be towards the latter half of the year. It's a little bit TBD. Now, when are they going to lower rates? Well, the Fed has a dual mandate. Their mandate is to promote maximum employment, right? Where everybody has a job, but stable prices, right? Where inflation is not going up more than 2% a year. They believe that that is the natural rate of inflation where prices can go up at 2% and still sustain maximum employment. So pretty much where we were at right before COVID, that's where they want us back to. The Fed wants to see unemployment stay below 4.5%. So one of their mandates right now is you got to stay below 4.5. Last year in July, unemployment ticked up from 4.1 to 4.3 in 1 month. That scared the Fed. They wanted to get ahead of the curve, and that's why they cut interest rates by 50 basis points in September, okay? So again, depending on unemployment, if it jumps rapidly too, that can cause them to cut. But generally, as long as we stay below 4.5, you're not going to see them cutting rates until inflation is a little bit closer to 2%. Currently, unemployment's at 4.2, and the Fed wants to see inflation at 2%. We're currently sitting at 2.3. We got that reading in today from last month. The year-over-year inflation rate has now dropped to the lowest level since 2021. The Fed wants to see 2%. We're not there yet, but we're getting awful close. Now, I'm not going to get into, my opinions on policy. I just want to talk about how maybe the Trump policies could affect inflation, how it could even offset higher inflation. Obviously, if they tariff the heck out of different countries, it's going to be the opposite effect. But if it's more of a negotiating tool and if they work these things out, then really you probably only have a one-time price increase, meaning that it's more transitory increase in inflation, and then it will abate. So, okay, the Trump tax reform of 2017, those are going to be voted on soon to have those extended. And if they get extended, things are just going to stay as they are right now. So you're probably not going to see any real impact regardless, unless those go away. If those go away, then we're all going to be paying higher taxes, unfortunately. Tax reform, okay, the different types of tax reform, it could cost us more money from the Treasury, in a sense, because we're going to be bringing in less money off of workers and off of businesses. But if it promotes more growth, then you could see companies not raising prices as much. You also could see more growth where now we're actually receiving more money into the Treasury because companies are making more money, therefore we're receiving more taxes. So tax reform, depending on how insane or how non-insane that it is, could actually be positive. Lower regulation, companies are betting on lower regulation under the Trump administration. This could cause companies to invest more into growth and again could add to the Treasury tax receipts. And then oil prices. So oil prices are already coming down quite a bit. If you guys remember, the last 4 years, they've averaged about $80 a barrel. Oil filters into everything. We still operate as an economy. 85% of our economy operates off of oil, even to make vitamins, to transport goods. Oil goes into those machines. Oil goes into our cars, into our transportation vehicles to move things. So if oil prices are down, that generally tends to bring down the cost to produce goods and to transport goods, which brings down inflation. Now, Saudi Arabia recently began dumping 500,000 additional barrels of oil into the market. That just happened. That's why you saw oil go under 60, and it's now sitting at just under 65. So because of them doing that, it's kind of like a put in the market that I don't think you're really going to see oil now go above $70 a barrel, and you're probably going to see it stay sub 65. That's going to be good for inflation. If you look online today on CNBC, you'll see a lot of stuff going on with Saudi Arabia and with Trump, and they're agreeing to invest $500 billion more into the U.S. And I have a feeling that this had something to do with potentially Trump doing some negotiations, because this immediately brought down the cost of oil. If you add more supply into the market versus demand, you're going to have prices come down. That's what happened. Some other compelling reasons for why the Fed could cut rates soon. The JOLTS report, that's the job opening and labor turnover survey. That shows how many available skilled jobs we have. There is now 7.19 million. Prior to the pandemic, we had 7.5 million. After the pandemic, 11.5 million available jobs. Same amount of people to work those jobs. That means if you want to get someone that's skilled to come and work, you had to pay them more to get them to come on, because they have a lot of job options. Well, now that it's back even below pre-pandemic, it just means that the labor market's a little bit, that there's less flexibility for people to negotiate higher wages. And if they're not getting such big pay increases all the time, it means that they can't spend as much in the economy. And that means that companies can't raise their prices as fast. And that ultimately brings down inflation. So the JOLTS at a pre-pandemic level is good to see, but it's not unhealthy. We still have a lot of available jobs. It's just a little bit more healthy than it was before when there's so many available jobs. Another thing is, this is a very important point. If you were to strip out shelter costs or rents, right? How much rents increase and decrease over time. If you were to strip that out of our inflation readings, because all of our inflation, our core inflation data has this included, right? How much are rents going up? And that bows into how much inflation's going up or going down. If you strip that out, we're already at the Fed's target. If you look at Europe, okay, the European Union, they don't include shelter costs in their core inflation reading, okay? They don't include it. If you were to compare us not including it and them not including it, we actually have lower inflation in the US than Europe does, okay? But they have cut their interest rates by 250 basis points more than us since the end of the pandemic. There's already, just that alone pretty much gives you a little bit of weight that the Fed could already be cutting rates. Oil prices are now sub $65 a barrel. Again, that's going to be anti-inflationary. And the Fed tends to adjust monetary policy before they hit their target. So this 2.3% reading today, market was expecting 2.4. Us to hit 2.3 is really, really good. And I think that if we didn't have these tariffs still lingering, I feel like the Fed could come out and start cutting interest rates again by June. But, you know, again, we just got a potential deal on China. It's not even signed yet. So the Fed's not going to do anything right now. And the labor market is still too strong and inflation is still too high. So they're probably not going to cut in June either. But again, these are all compelling reasons for why the Fed could begin cutting again soon, and why they still have the 2 rate cuts on their dot plot for this year. And then again, why is the Fed not cutting rates or open to it at this point? Again, the tariffs, will the impacts be transitory, meaning a one-time price increase, or will it feed inflation, causing businesses to continue raising prices? They just don't know yet. The labor markets continue to hold up well, right? We still have unemployment at 4.2%. It's just not high enough for them to have to move rates. Another thing is retail sales and consumer spending. You guys, the survey data shows that the consumer is, consumer confidence is really, really low right now, probably because the stock market ride that we went on in April was pretty brutal. But that didn't make consumers stop spending. They're saying one thing, but they're doing another. And so retail sales, consumer spending is still super, super strong. And then again, the tariffs. What just changed is now the U.S. tariff rate on China is 30%, and the Chinese tariff rate on goods that are imported into China from the U.S. has now dropped down to 10%. If those hold, I think we're in a dang good place, a lot better than we would have been in. I'm running out of time here, you guys, so I'm not going to cover this in too much detail tonight. What you're looking at, though, is the Fannie Mae 6% mortgage-backed security. This is basically what I look at every single day. As investors are buying mortgage bonds, it causes this bond to go up in value, which brings down the yield that makes rates better. And as this goes down, it's investors selling the bond, causing the bond to depreciate in value, which drives up the yield that makes rates worse. My 5 highlighted points are back there on the left-hand side on 11/14 of 2023. That's when mortgage rates were at 8%. That's when inflation peaked. That next highlight is when the Fed cut rates for the first time since 2020, when unemployment had hit 4.3% in July. They cut 50 basis points. The third line is when Trump won the election. Rates worsened ahead of time because we knew that his policies would be very pro-growth. And then the fourth highlight is where we were trading when we had a flight to safety and everyone was buying bonds after Trump announced the tariff war on April 2nd. And then you saw an immediate sell-off, which was other countries dumping our debt, probably as a way to negotiate with Trump. And you saw bonds worsen and you saw a flight to cash. Everybody was selling everything. And then the fifth highlight is where we're at today. We're trading below the 200-day moving average, which is not a good sign for mortgage rates. But I believe you'll probably be trading back above that here soon. A little bit of what you have today is just money moving back into the stock market because they feel more comfortable because the China disaster appears to be moving behind us. My last point is, you guys, this is just a chart that shows that inflation lags behind, or rather 30-year mortgage rates lag behind inflation. So over time, as inflation does get lower, you'll probably see 30-year mortgage rates come back down. Our estimate is that by next year, you'll probably hit the fives, the high fives. I wouldn't expect it this year. If it happens, great, but probably not going to be until next year for that. My weekly market update goes out every single Saturday. If you guys want to be added on, send me over an email. But that's going to do it for me and for my presentation tonight.
Awesome. And let me just quickly go through these last slides here. So when we're talking about properties and investing, this is like the Marshall Reddick Bible for investment properties. Take a look at it. It goes into property classes, help you determine what you're looking for in an investment. And we can always talk further on a consultation request. Feel free to look up Marshall Reddick online, look up Reed and his team online, raving reviews from clients, which is really cool to see. See what other people say about us. Feel free to follow us and write us a review. Let us know how you liked this presentation. Feel free to just comment on Yelp. Say, hey, this was great. This is what I learned. It's super helpful. Goes a long way for helping other people find our webinars and events just like you guys. And then a couple more things here. We'd love to schedule a consultation. Here's our contact information here. Feel free to write it down, take a picture. We'd love to get on a follow-up call with you guys. And then Reed, if you're okay, let's stay on for just a couple minutes. There's a couple questions I want to get answered from some people in the chat here, and then we can kind of let go of everything. Okay, first one is, do you do DSCR for a second TD, or does it have to take out the first TD?
It has to take out the first trust deed. So there's no seconds allowed on a DSCR loan. You'd have to get a home equity line of credit. We can do those. And it's a little bit more of an automated system now. So even if your debt ratios are a little off, it's still worth applying. HELOCs have become a lot more automational than before, if that's a word. Okay, so, but yeah, generally you have to take out that first and do a brand new loan.
Okay, awesome. And then a couple more here. Do you offer financing for land trusts or LLCs?
Yes, we do. And that's a DSCR loan product, and we can do long-term financing for that. I know Marshall Reddick also does that. And Marshall Reddick also does a lot of fix and flip financing, and they do that for people that have LLCs as well. So definitely reach out to Cameron and I, and we can handle that regardless of your scenario.
Absolutely. And last thing, just a quick one here. What are rates for investment properties, DSCR, purchases, and refis?
DSCR interest rates with like no loan points are going to be like a high 7%. And then, depending on if you were to do some buy down, then you can get those lower. But in general, they could even be in the low 8% range to mid 8s, just depending on your scenario. But by and large, like a purchase DSCR rate is going to be like a really high 7%. And then there's a lot of different buy down options available.
Awesome. Cool. You kind of nailed everything. Thanks, everybody. Thank you, and have an absolutely wonderful night. The presentation will be sent to you in the next 24 hours, just the recording and the slide deck, and feel free to reach out to us and follow up. You can reply to the email after the presentation is sent to you too. Either way works, and we'd love to answer your questions and dive a little deeper. Have a wonderful night, everybody. Thanks, Reed.
Hey, thanks, Cameron. Thanks, you guys. Have a good night.